Welcome back to the Free Forum Project. For today's financial literacy segment, we are going to explore a key financial component that determines the underlying cost to finance anything. Welcome to Understanding Prime Rates. Have you ever wondered how banks determine interest rates for loans and mortgages? While there are many factors that influence these decisions, it all starts with the prime rate. The prime rate is the interest rate that commercial banks charge their most creditworthy customers. It serves as a benchmark for other interest rates in the economy. The Federal Reserve System, as previously discussed, sets the federal funds overnight rate, which serves as the basis for the prime rate, which is the starting point for other interest rates. Banks base their rates on the prime rate because it reflects the overall cost of borrowing in the market. When the prime rate increases, so do the interest rates on loans and mortgages. But how exactly is the prime rate determined? Well, it largely depends on the Federal Reserve. They have the power to influence the prime rate by adjusting the federal funds rate, which is the rate banks charge each other for short-term borrowing. As of right now, when making this video, the Fed funds rate is 5.5%. Which means at the time of producing this video, the current Bank of America, N.A. prime rate is 8.5%, rate effective as of July 27, 2023. The lowest financing percent, which is the rate at which the banks borrow money, plus the added basis points, percentages, formulates the prime rate. When the Federal Reserve lowers the federal funds rate, the prime rate tends to decrease, making borrowing cheaper. Conversely, when they raise the federal funds rate, the prime rate typically increases. This explains why the cost of financing has drastically increased recently. As the Fed has been increasing interest rates, this raises the cost for banks to borrow money. That, in turn, affects how much it costs businesses and individuals to borrow money as well. It's important to understand that the prime rate is not the same as the interest rate you'll get on a loan. Banks typically add a margin, touched upon earlier, to the prime rate based on your creditworthiness. Factors like your credit score, income, and assets will determine the margin. The better your credit profile, the lower the margin, and vice versa. So, when you see an advertisement for a loan or a mortgage with a certain interest rate, remember that it's likely calculated as the prime rate plus a margin specific to the borrower. Fair disclosure laws do not require banks to publish every single interest rate available when advertising. That means they will likely only promote the lowest possible rate that is obtained with the best creditworthiness. When you actually go to an institution to borrow, you will receive more detailed rate disclosures that pertain to your particular circumstance. Understanding prime rates and financing interest rates can empower you to make better financial decisions. It's crucial to shop around and compare offers from different lenders to get the best terms for your situation. Never just accept the first rate that you are offered. Check out some of the other videos about financial literacy on our channel to better understand credit scores and budgeting so that you can make the most informed decision. Thank you for watching. We hope this video has given you a clearer understanding of prime rates and financing interest rates. Be sure to like, share and subscribe to our channel for more financial education content, as well as to stay current with all the other content posted. And remember, as always, think freely. Discuss openly.